Assalamualaikum and hi, my name is Megat Faiz Irsyad bin Zaini. I am from class GBA 251-C. Today I would like to present infographic about chapter 5 and chapter 7 in subject Fin 430. On chapter 5 we will cover on capital asset pricing model or CAPM, and chapter 7 is working capital management. We start with the capital asset pricing model, like CAPMs. We start with the definition. The definition of CAPM or CAPM described as a relationship between systematic risk and expected return for asset or particular stock. CAPM is widely used or usually used throughout a finance system for pricing risky securities and generate expected return for asset given the risk of those assets and cost of capital. Okay, next is a CAPM formula. CAPM formula can be described can be the formula for calculating CAPM or expected return of an asset given its risk. First is expected return equal to risk-free rate plus beta of investment and times with the market risk premium. As we can see on the infographic, there is a short form that is ER, stand for expected return of investment. RF stand for risk-free rate. BI or beta stand for beta of the investment. ERM minus RF equal stand for market risk premium. Next is a security market lines, or can be called as SML. SML is the picture of the CAPM. SML reflect the investor required return for each level of non-diversified risk that measured by beta. As we can see in at the infographic, there is stated that the SML the example of SML graph. To read the SML graph is the y-intercept of the SML is equal to the risk-free rate interest rate, and the slope of the SML is equal to the market risk premium and reflect the risk return trade-off at a given time. The next is investor decision. Investor decision is based on the SML graph. After we done with the CAPM and SML, it will affect investor decision where there will be a two answer or two decision, not a two decision, that two answer. The first answer is overvalue and undervalue the stock, whether the stock is overvalue or undervalue. The investor decision when the stock is overvalue is sell, and when the stock is at undervalue, it is buy. Okay, the last is objective of CAPM. Objective of CAPM is to evaluate whether the stock is fairly valued when its risk and the time value of money are compared to its expected return. Okay, for next is working capital management. We start with the definition of working capital management is a business tool that helps companies effectively make use of current asset and maintain sufficient cash flow to meet short-term goal and obligation. Next is policies of working capital management. There are three policy. The first one is a relaxed policy. Relaxed policy also can be known as a low risk policy. The firm maintain large amount of current asset coupled with liberal credit policy, high liquidity and potentially low return from investment due to low productivity of current asset relatively to fixed assets. Next is a restricted policy or a high risk policy. There where current asset is reduced to a minimum with a stringent credit policy. Lower investment in current asset enable the firm to increase investment in other productive investment and thus will result in higher return. Next is a moderate policy, where it in between at in between at restricted policy and relaxed policy. Uh, Moderate policy will result in moderate risk and return. Investment in current asset at a minimum level without sacrificing liquidity requirement. Next, we go to the approach of working capital management. There are three approach. The first one is a hedging approach. This approach matches the financing duration and asset requirement. Therefore, there is no need for emergency fund and idle fund are non-existent. Or we can be call it as a moderate instead of because it between the another two approach. The second approach is aggressive approach. Aggressive approach involve more risk. It use short term of temporary financing to support a relatively large portion of current asset. The next one is a conservative approach. On this approach, it involve a lower risk compared to other approach. It use permanent financing to finance the majority of its assets. Okay, next and the last for the last list is how CAPM and working capital management have been used in the company. Okay, CAPM is used to give a first cut or baseline answer. Okay, for example, you are a finance manager, or maybe have a okay. For the last is how CAPM and working capital management can be used in the company. Okay, firstly, CAPM is used to give a first cut of baseline answer. Imagine you as a finance manager in a company. You are required to evaluate the investment manager. First, when you want to evaluate investment managers, some of them run high funds and some run low risk. Some have high correlation to your existing portfolio and some have low. As a first cut, you compute how much alpha they have generated in the past. Alpha is defined as their actual return minus the return expected from CAPM. Next is for working capital management. Working capital is essential to a company fundamental financial health and operational success as a business. Working capital management is to maintain a solid balance between growth, profitability and liquidity. A business use working capital on its daily operation. Working capital is the difference between a business current asset and current liability or debt. Working capital serves as a metric for how efficiently a company is operating and how financially stable it is in the short term. The working capital ratio, which divides current asset by current liability, indicates whether a company has adequate cash flow to cover short-term debt and expenses and can meet the short-term obligation. Okay, that's all from me. I will I will state the infographic on the last part of the video.